You're 65 years old. You're nearing retirement. Month after month, you're watching volatility take your portfolio higher or lower.
So here we are down 1,000 points today.
Major losses across the market Tuesday.
What do you do? What's the right way to think about the day-to-day, month-to-month volatility that you're experiencing? The typical advice in volatile markets or for people who are nearing retirement is for them to, quote, lighten up a little on stocks or to, quote, take less risk. That's not as easy as it sounds, and I'll explain why. I always remind people that a 65-year-old woman has a better chance than not of making it till age 85. Now, what about the reverse? Let's say you're a man, 65 years old, and you're watching this video. You have a 22% chance of making it to 90. That could mean spending decades of your life in retirement really just living off your investments. So in order to do that, you might have to take a lot more stock market risk today than what previous generations have had to do and than what you might already be comfortable with. Look, here's the deal. Because of inflation, risk is guaranteed. The question is, when do you want your risk? Do you want it today or do you want it much later when you have bills to pay and you run out of money? I think everyone understands intuitively better to take the risk now while they're younger, while they can replace any income lost in the market. So that is really the question that faces every investor, and I think that's a more important consideration than how to deal with today's volatility. Here's an example. Let's say you're 60 years old, you've got $1 million portfolio, taking Social Security, and you're spending about $40,000 a year. Chances are you don't have to take more risk with your investments, you'll be just fine. Now imagine spending about $90,000 a year. The math changes. Probably you're gonna have to take more equity market risk and endure more fluctuation or cut back on your lifestyle, maybe spend a little bit less money. So that is the calculation that every person that's close to retirement needs to do. And I think when they do it, they recognize, hey, you know what? In the grand scheme of things, a little bit of stock volatility isn't the end of the world, as long as I can take it today.
Not in generations has Wall Street absorbed the number of body blows it took today.
Lehman here is going bankrupt. Meantime, Merrill Lynch is getting bought out.
The 2008 financial crisis really played havoc with a whole generation's worth of investors' psyche, and it kind of led to a lot of poor outcomes in the years since because people equated every bout of volatility with the next crash. And people saw the next financial crisis hiding behind every tree and shrub. And so as a result, you really did end up with a lot of people that did not get the benefit of the stock market's recovery or paid too much in fees to people that were betting against the market or had too much cash or some combination of those things. So you had a lot of bad outcomes come from what was frankly a once in 100-year storm. So there are going to be bear markets, there are going to be bouts of volatility, there are going to be bad years. It's part of why stocks work long-term is because there is risk. But I think expecting the worst outcome behind every bout of volatility is probably going to have you investing your portfolio too conservatively. One of the things that you'll hear from people is they'll look at demography and they'll say a really big risk to stock prices are the baby boomer generation. There are 70 million of them still alive. They're going to be exiting the stock market as they retire and living off that money. It's almost childlike in its ridiculousness. So I'm going to take each of those points one by one. The first is being a boomer in the year 2020 is vastly different from being a boomer in the year 1990. We all understand that lifespans have elongated. We all understand that people are working longer. We also understand that intergenerational money is a much bigger issue within wealth management. People are investing now for their grandkids' benefit, so they have different asset allocations than they might have when they were just investing to live the last 5 years of their life. Really, retirement is something that was invented in the last 50 years. It didn't exist. So today's market and today's retirees have much different attitudes about how they're investing, what they're investing for. They're going to live longer. They're going to take more equity risk. They're going to liquidate portfolios much later if they ever even do it at all. Today's ballgame is a totally different ballgame. One of the most important concepts in wealth management is after-tax returns. And so if you're invested in a strategy that has you jumping in and out of one asset class or one type of investment frequently, the returns that you end up with are going to be affected by what kind of tax liabilities you ended up generating for yourself. And when we vet other strategies and we look at some investment schemes where people are timing markets or people are adding more and then taking more out depending on volatility or whatever they see happening in the economy, the after-tax returns on those strategies frequently look way worse than what the investor would end up with if they did almost nothing. So let me wrap this up for you. One of the things that you might want to do is get a financial plan done so that you can actually have a mathematical reason behind the asset allocation that your portfolio has. Like, why do I have this much exposure to stocks? What is this meant to do for me? When can I lower that exposure? Do I have enough exposure to carry me through all of the goals that are important to me and the end of my life? Frankly, that's a very personal conversation. It's very bespoke. There's no right answer that applies to everyone. Everyone's got a different situation. But enduring volatility probably is not going to change very much from one 65-year-old investor to the next, from one 45-year-old investor to the next. The older you is going to say thank you from the future. If such a thing were possible, maybe they'll invent that. But I think what I'm trying to say is the real risk is not what's happening today in your brokerage account. The real risk is to live a very long period of time and to have a lot of that lifespan take place during retirement.